Good morning, everybody. My name is Steffen Meister. I'm Executive Chairman of Partners Group. We are a pure-play private markets firm, the largest one actually in the extended middle market, and it's a great honor to host this panel today about stewarding long-term assets. It's not only a challenging environment, but it's also actually a demanding topic, so I'm very happy to be joined here by true experts and authorities in this field. And maybe by way of brief introduction from my left to the right here, we have Blake Hutchinson with us today, President and Chief Pension Officer of OMERS. We have Neil Cunningham, President and CEO of PSB. We have Sophia Cheng. You are CIO of Cathay Financial Holdings, but you're also a teacher at Taiwan National University. And we have Alain Carrier, who is a Senior Managing Director of Canada Pension Plan Investment Board and responsible for the international business. I take that I don't have to make a long introduction of your firms. I think you are part of the crème de la crème of institutional investors globally. I also got your permission that I don't have to spend a lot of time with your bios. I mean, you have all very impressive biographies, for sure, but they also tend to be lengthy then. So I want to save a little bit of time for the panel here, actually, if you don't mind. What I'd like to do is still, as a brief round of introduction, to give us a bit of perspective for the discussion later on, if you could just introduce your mandate, so your firm and your mandate, what are your objectives, what's your time horizon, what are your return objectives in your mandate, so that people can maybe put the discussion later on a little bit into a context. Shall we start right with you, Alain? Is that okay?
Absolutely. So we're the investment organization that's tasked with managing all the capital that is not needed to finance the Statutory Pension Plan of Canada. So the CPP stands for Canada Pension Plan. We're separate from that. Very long-term investor. The system has cash excess, contributions versus benefits being paid every year. So the fund is in a fairly aggressive growth trajectory. We stand at about $400 billion Canadian today. There's a trajectory to $1 trillion to $2 trillion of assets under management. So that means that we have an incredibly long-term focus, and we have the ability to take a number of positions, manage the portfolio with that long-term perspective in mind. And that really is our mandate. At the core of it is to be able to add value in scale with a very long-term focus in mind. I'll probably keep it at that.
Sophia, how different would that be for your firm?
I work for Cathay Financial Holdings, which is the largest financial group in Taiwan. We have life and non-life bank, biggest life, second largest PNC, second largest private bank, biggest asset owner, asset manager in Taiwan, and small venture capital and broker. The company, the flagship company, Cathay Life, accounts for about 60% of the assets. The total asset for the group is about $300 billion US. So 60% in life, 40% in bank. The biggest challenge we have after year 2000, when interest rates start to fall, we spent over a decade trying to manage the negative spread book. And that's a similar story that you saw in Japan before. And so compared with year 2000, we invest so much more in fixed income, in overseas market, in broader asset classes. And the assets tend to be very, very long term. Imagine you sell a new insurance policy to a newborn. We basically make a promise we'll be alive longer than their parents. So each day I will ask my team whether they have the commitment to be a sustainable company. So that's the main mandate. So it tends to be very long term, and with the negative spread still there, but it's quite manageable. We also run a realized gain investment book that we have still some accounting earnings that we need to achieve.
Good. Let's turn back from Asia again to Canada. So there's not so much diversification, I realized actually when I got the names for this panel. I mean, there's those 3 Canadian very large pension funds, but let's see. Neil, how different is your mandate from CPP's mandate?
Great. Thanks for having me. Good to see everybody today. So we were actually, as a manager, created, I think, on the same day as the CPPIB, and we had similar profiles at the time, big inflows of cash. The PSP is the Public Sector Pension Investment Board, which means we manage the pension monies for the Canadian Federal Service, Army, and Royal Canadian Mounted Police. What's different from us now, though, is we started with a liability profile which was pure inflow. We're now, as the liability profile is changing, going to sometime in the next 10 years, have our net inflows reduced and eventually become negative, although the growth will continue because return on the fund will continue to far exceed anything rolling out. So we're about $170 billion under management today, growing roughly 7% a year, combination of expected return and inflows. So we'll double in 10 years, and then we'll double in 10 years after that. So our task is to earn, the actuarial target is 4.1% plus inflation, or 4.1% real in Canadian dollars. And if we achieve that, then we'll do our job. If we don't, then others will have issues.
You'll notice that there's a mix of Canadian and US dollars on this panel. We use Canadian dollars, it sounds more impressive.
Yeah.
So you may want to...
Blake?
I'm going to definitely use Canadian dollars because I'm the little guy in the room against these big Canadians. All three of us are nice, though, because we are, after all, Canadian. So we've opened an office here recently, and I'm going to have to try harder to get known because we're $100 billion. We'll be $200 billion in the next 8 to 10 years. If you remember nothing else, today we're about 10% allocated to this region. We'll double in size over the next 10 years, and we want to double out our allocation over the next 10 years. So we could go from roughly $10 billion to $35 or $40 billion focused on this region in the world, which is pretty exciting. We've opened an office here. We have 15 people. We should be 50 people, we think, in the next 24 months. And thank you to many of you in this room for welcoming us to Singapore, metaphorically and otherwise, because we're excited about our future here. So we're $100 billion, and we've been 35% invested in Canada, roughly 45 US, and sort of 10 to 15 Europe, and 5 to 10 here. And as we project to the future, we will downweight Canada, downweight US, and get a better proxy of the world economy by coming to India, Asia, and Australia. And what's interesting, the Canadian pension plans, we're all very different. We have a liability stream that is at or about our asset value today. So we are consistently having to balance the inflows and outflows. Unlike CPP, for example, which is more of a fund, we are more of a plan. And we have to plan every decision we take around our liabilities. And the liabilities, for some reason, are impervious to interest rates and what's happening to the age population. They just know they need to be paid. So we wake up every day using that as our starting point. And we're having a lot of fun in this part of the world and want to do business with you guys.
Thanks, Blake. Let's talk a bit about asset allocation. Now, asset allocation depends, of course, on your mandate, what you want to achieve, and it depends on your liability profile. If you have one, you have to match. Maybe CPP is a little bit more free on this one. But it also depends, of course, on expectations on what is in with long-term assets, private market assets in particular. And so if we can actually use a slide here, I've got 2 slides. I will not bore you with many slides, but 2 I have with me. If we could maybe use that one quickly. Perfect. So I borrow actually from some of our own publications here, just as a basis for that discussion around expectations. So what you see here is actually our expected return framework. It's, in simple words, essentially a model to calculate 5-year forward-looking returns for asset classes and instruments. At a high level, very simple. You essentially look at the income, you look at the growth component, and maybe certain valuation changes that you assume over a 5-year period. There's 2 examples here. One is for public equity. I don't go into the details here. You get out about 5% net. That's actually US dollar, but with a kind of a global equity allocation. And for private equity, the net returns, industry returns, would be about 10% as a number. If I say industry returns, that's important because in private equity, I think many managers try to achieve much more than that. I think our own funds would probably be up 300, 500 basis points higher than that. Now, if you turn one more slide, that's the more important one, and look at the left-hand side, what are the expected cases in a base case? A base case in our world is modest growth for the next 5 years. Valuations come down by 10% or so. Low inflation, and you see that we expect returns in the private market, in the long-term assets, that are in average about 3, 4, 5% higher than in public markets. That model is, of course, or that's just very simplified now. If anyone is interested, I'm sure our teams here or across the globe are happy to explain that more detailed. There have been many publications on this. There's a couple of hundred investors, large investors these days, that use the model. I want to use it today actually just to see where do we have controversial views. What's your expectations from long-term assets? How do you find the long-term assets actually? And then let's talk a little bit about the allocation to individual long-term asset classes. Who wants to go first?
Well,
Doesn't matter. You go ahead, Al.
no, I'm happy to start. I mean, look, we would obviously, I would expect you to have that view, but we would also agree with you, I think, generally.
I should be unbiased, you know. I mean, we are a Swiss headquartered firm. I've got a Swiss national passport, so I'm neutral.
Well, you have 3 Canadians on the panel. Canadians are also known for being very nice and typically neutral, at least perception. I'm not going to change that today. To your point, I mean, given that we have cash piling up into the system, excess contributions to benefits being paid due to the structure and the recent reform in Canada, the CPP, we are looking at a trajectory of assets that's significant growth. We're very partial to long-term assets. You know, just by definition, I think we think that's where the value can be created. We spend a lot of time building up an active investment infrastructure within CPP. We have large teams all over the world. We invest mostly abroad. We don't invest much in Canada. We are very global. We actually have a particular focus on emerging markets, Asia being the lion's share of that. We've been public about saying that between now and 2025,
You escaped a little bit my question. So how do
No,
you
I'm
see
coming
the
back to it.
returns? Okay.
I'm coming back.
He's done a beautiful job so far, hasn't he? Avoiding it?
It's crazy. So we think private assets are actually the way to build value. And the way I was coming to your question is saying you're only going to be able to build value if you have a long-term horizon. Private assets will outperform if you have the flexibility to manage them with a long-term focus, the flexibility to actually add value, actively involve on the board and the governance of these assets, and you can hold them through cycles, which I think is critical as to how you think about private assets. Everything you had as an assumption on your slide is actually what we believe is the benefit. There's no shortage of capital in the world today. How do you add value? How do you justify your existence at a cost of your organization? Is if you're going to take an active management perspective to investing, and that's what we do. That's why for that focus, most of our portfolio is actually slanted towards long-term private assets.
What is roughly the asset allocation at the moment?
So we are at the portfolio level, 85% equity, 15% debt. How that breaks down, we don't have formal asset allocations per strategies, but we basically assign a component of risk to each asset. It's a dynamic portfolio that way. Given where we started from, private assets will make up about 65 to 70% of our portfolio today. And it's spread internationally. And I think within that, you have real assets, you have private equity. The private equity component of the portfolio keeps increasing. Even with public or listed assets, we take a very active management approach. We sit on boards, which is one of the questions you had. We try to be hands-on owners, which is frankly the best way to add value long term.
So how different is that with the other 2 Canadian pension funds? If you compare maybe.
Can we go back to the
If you could
your
go back to the
return
slide.
assumptions there? Because you know, we all look at, of course, those components of a potential investment, but when you look at the, there was, you were showing a
pull up
loss.
the slide again?
Everyone, if people here are investors, they'll remember what was on the screen, I'm sure. The last column saying, you know, we're expecting a slide before that, expecting to see valuation decrease because of call it cap rate expansion, if you want. That may happen, and everyone makes an assumption of what they think is going to happen. But if you make that assumption in today's market, it just makes you a non-buyer.
Right.
So you have no ability to add value or grow your portfolio because you don't actually have the asset. And that's one of the realities of the market today is there's so much money looking for especially quality assets that even if this is right, it doesn't matter.
It's interesting you say this. We might come back to this because that's sometimes the conflict we see as a private market firms where maybe the assumptions underwriting, they are sometimes a little bit more conservative, rightly or wrongly. But that makes our lives sometimes very difficult, that's for sure.
No, I'd agree with Neil. If you take your exit caps and cap rates come up or multiples go down and that's your starting assumption, I believe on a very consistent reasonable mid-market portfolio, that's probably true. And so I think all of us go after the very, very best assets you can get in a marketplace. You roll out your secondary assets, strive to get the best in the market. And when that's true, fundamentally, you have to believe that money's worth more today than it is tomorrow, which is why you learn in business school on the first day to discount cash flows, and great assets are worth more tomorrow than they are today. And all of us are sitting on a book that's 20% fixed instruments of some sort. We all know what's happening to that market in the world. We're screaming to get more money into our privates and areas where you can unlock real yield. And by definition, for great assets, given that dynamic today, we believe that tomorrow's real estate, infrastructure, private equity assets, the good ones, will have cap rate diminution, multiple expansion. That would be my only reflection or refutation on what you're saying here.
Before we turn to Sophia, can you just add a word on your asset allocation, how much you roughly invest in long-term assets?
So we're call it 100 billion today. We're roughly 50 billion in capital markets. 30 of that is growth and equity. 20 is in fixed instruments. Of the remaining 50, we're roughly 20% infrastructure, roughly 18% real estate, roughly 20% of private equity. And interestingly enough, we allocate at least $1 billion or 1% of our book at any given time to startups and innovation. Mm-hmm. And that's pretty unique in the world, pretty unique in Canada. We've set up offices in Silicon Valley, set up offices in London to unlock that. And we've been pretty popular, and I know we will be in this room because we really believe in, it's almost irresponsible not to be investing in the new economy.
Neil, how much was that in your organization? How much does...
of our allocation, it's $1 billion of equity, and with leverage and partnerships and other things, it's hovering around a $5 billion book today.
And Neil, how much would that be for PSB roughly? How much have you in private markets overall?
Well, you talking overall allocations or new economy?
No, sorry, overall.
So we are roughly 50-50 between public market investments and privates. The privates has been increasing, and we expect it to continue to increase. I don't know that we'll ever get as much in private as OMERS is, but we're going that direction. And it's split between real estate at 15%, private equity at roughly 13%, infrastructure at 10%, which we would like to be higher. This is the problem, this graph we're looking at for what, where you have to trade stuff. Two interesting asset classes for us, which are the most recent. One is our, we call it natural resources, but it's really agriculture and timber, and private credit, which are both, I think, places where we've been able to differentiate and create some value by investing, say, outside the lines of the traditional asset classes and capturing some risk premia that we weren't getting before.
Sophia, so you have a slightly different mandate in your organization. I believe for you debt maybe plays a little bit a larger role. Mm-hmm. Maybe can you share a little bit your asset allocation considerations with us? Okay.
The life book totally about $200 billion US. And after 2000, given a lack of supply for government bond, corporate bond, there's abundant liquidity in Taiwan. So the interest rate is far too low. So we have been learning how to be a global investor with broader asset classes, more geographic location of the assets. Of now, we have total asset more than 60% in fixed income. And we have, among the pure bonds, only about 4% in high yield. We are a bit cautious on the current macro cycle, despite we think the credit spread is a bit spoiled. And the rest, we have about 12 to 15% in equity, half domestic, half overseas. We have around 10%-ish in secure loan that includes mortgage and loans to corporates with collateral. Another between 5 to 10% in policy loan, which is the borrowing against insurance policy and their cash value. We have another about 8% in real estate. We are one of the biggest commercial building owner in Taiwan, so we have stable rental income. And lastly, in terms of alternative investment, there is a regulation constraint, no more than 3% of the invested assets, but 3% of $200 billion US is still quite sizable. That's an area we are growing. And we tend to take a model, when I buy a fund or give a mandate, I tend to put it into satellite and core. The satellite means depends on microcycle, we may subscribe, we may redeem. And once they have very good long-term track record, it becomes the core, it will be someone we are happy to have very long-term relationship, and it becomes sticky. So for example, in 2014, we talk about tapering, and we think, we don't know where, but sometimes somewhere in emerging market may start to show volatility. If it's core, we will talk to the mandate manager that's switching my money from EM to DM, for example. So we were adjusting our portfolio depends on my macro view for structure change. And at the end of the day, I'm very excited to look at yield enhancement, but there is a cost for yield enhancement. So as an insurance company, when you do investment, you think about liquidity risk, credit risk, duration risk, forex risk, and one-off gain risk. You probably need to take 3 if you are Taiwan insurance investors. And the one we care the most is liquidity risk. Because when you see in 98, 2000, year 2008, when you need the cash, in 2008, you were having one of the biggest insurance companies, either in US, they fell, and because they think CDS will never fail, or European company, because the IFRS, they are pulling out capital from Asia to retrieve the capital release the capital for a parent, for example, ING. So they were one of the biggest insurance company that exit Taiwan. And you can see at that time there were some insurance policyholder very happy to borrow against the policy. It's more like paying expensive insurance in case a company fail. So we always say liquidity risk is very critical, and therefore when we invest in these various private instruments, whatever we do, we care about liquidity a lot.
So if I listen to you, I mean, it seems to me you have actually the hardest mandate amongst the 4 of you.
Oh, it's much better. In 2007.
We'll vote on it.
I guess the reality is in insurance context today with all the rules, I mean, it is actually very tough.
It is very tough, actually. You think about you get nothing you can invest in, limited, you can invest in Taiwan with a decent yield. And at the end of the day, asset allocation means risk allocation.
Yeah.
So where do you go, and every asset you take, how do you respond to the risk? Yeah.
So if you don't mind, let's turn a little bit to how you actually invested. I mean, especially, in the 3 Canadian funds, you invest very significant amounts of money in private markets, which is very challenging today. It's a very competitive market. That's research. I mean, our decline rate on transactions has gone up to, a super high level in the last 24 months. We invest about $15–20 billion a year as a firm, but it takes a lot actually of transactions to do that actually. So let me understand a little bit how you invested money. It's what 3 of you have in common is that you have, for instance, co-invested with us on deals in the last 24 months, but I think there's big differences. Some of you have a very large direct practice, you do funds, some of you focus only on direct, some of you I think a little bit more on the fund side. Tell me a little bit about how you actually make that decision and how you actually access that. You're all screaming for yield and for this exposure. What's the recipe for success for your institutions here? Who wants to go first? Blake.
I think the truth is we're all very different. And one of the things that's, when you look at the Canadian pension plan world, Canadian pension plans are outpunching their weight class globally, and I think you see that. And there's really 2 fundamental reasons why. Our legislators 20 years ago said we have to allow Canadian pension plans to be able to buy platforms, which would not be true, for example, in the United States. And they also gave us separate board of directors and enough autonomy to pay people competitively against the best of the best in the world when you have to compete. And I think those 2 things have allowed our little country become a dominant player in the pension plan space, and I think there's good learning there. But we're all so different. We're also different because of our liability streams. We're also different because of our size. We're also different because of our maturity as a plan and as an investor. So one of the things, I'll take our real estate book, for example. We are very active, hands-on investors. We set up a real estate platform called Oxford Properties, which many of you know. And we said we're a direct drive investor, we don't invest in funds, and we've scaled that business. We bought a platform in 2001. It's today about a $55 billion business. It's gone from 95% domestic. I ran the business for 9 years, so I lived it. We went from $17 billion Canada, to today $55 billion global.
How global is that big? I mean, real estate is a very local business, right? So that's quite different from maybe infra and private equity. How can you run with your team that business? You just focus on certain areas? Or?
We just woke up and we put together a strategy. We said we're going to be in Boston, Washington, New York. We're going to be in London and Paris. We're going to be in Berlin. Those were our
Okay, so you focus essentially on certain
We put people in those markets. The first transaction we did in New York was Hudson Yards.
Yeah.
So we went in with a bang, 50% of the GP. All of a sudden, people knew who we were. We went into London. First transaction we did was the Leadenhall building, the cheese grater, which many of you have seen, 50%. All of a sudden, everyone knew who we were. So
you focus resources to make a difference.
We'd put in somebody that knows our DNA, then we'd scale a team around it. We'd usually do some monumental transaction. Berlin, our first transaction was the Sony Center. So all of a sudden, people knew who we were. So we've been able to go from 95% Canada to 45% Canada. We've grown at 22% a year. We've averaged 12.3% returns. These guys have been our partners. CPP have been our partners. That's a good example of using...
How many people do you have overall across
that business
asset classes?
2,200 people. The real estate business itself costs $250 million to run, and we generate $220 million of fees against it. Because of the $55 billion, $20 billion of our equity, $20 billion debt, $15 billion third party. Some of it we fee guys like Neil a little bit.
They're a bit high, those fees.
I'm sure they are. So we have a business that costs us $30 million to run. That's a $55 billion global business. So that's a good example of trying to use our might and outpunching our weight class.
How would that be for CPP?
Well, we don't have an external manager of the same sort, but that's actually a debate that we've had a number of times internally. So our real estate practice is fully internal. Our view is, given our scale and given the speed at which the asset base increases, we have to be quite effective in how we deploy capital. So we'll do, I think your question was only private or private and public. We do both, as you know. We've done deals with you. We invest also in some of your platforms. And that's how we manage. If I take private equity as an example, efficiency of capital deployment means that we have large internal teams doing direct transactions. We'll be partnering with GPs because we put a lot of capital into GPs as well. And we'll do a number of transactions on our own that are longer term focus, that are not straight buyout, to try to actually have more efficiency in how we tackle the market. To your point, it's a very well intermediated industry. There's a lot of capital that's been raised. And so you have to take a lot of time with teams on the ground. That's why we have large offices abroad, to try to find the right situations that are actually tailored to your identity as an investor. And that's how you add value. The flexibility you have in terms of holding, in terms of capital structure, in terms of how you look at the dividend stream, reinvest in your companies, is how you add value in long term. And that's basically what we do across most asset classes. We're mainly a direct investor. There are two strategies where we will also have a fund component to it, private equity being the largest one, the hedge fund sector, and the public mandate as well. Everything else we do will be direct, and we've built the teams to be able to achieve that globally. We've made a big decision to shift to emerging markets, where we think actually in terms of diversification, it adds a lot of potential returns to the portfolio for the same unit of risk. And so between now and 2025, we've been public about the fact that up to a third of our portfolio will be emerging market focused. The lion's share of that will be in Asia, between China and India, with South America playing a role. It's quite focused. But we think, again, you can only do that if you build the teams on the ground, if you have the relationships on the ground, and if you have the deal-making capabilities on the ground to be able to look for that elusive value-added transaction. So the focus, the ambition is there to do that. But we've kept everything in-house. Our real estate team is fully in-house. We don't have external capital to manage, which is just a structural decision.
Sophia or Neil?
So I like to say that we're in the business of getting married, which you could also say we're in the talent spotting business, which is ironic because our private equity guys recently invested in a talent agency. But what we try to do is everything. The way we set up our businesses is designed around deal flow and generation of deal flow with the talented managers that we can partner up with. So as you said, real estate's a local game. We believe that partnering up with people who are local as the operating partners, including you in some places where you do have the expertise, is the way to go for us. And each of our businesses has evolved in a different way, depending on how we could define that. I mean, I would describe our partnership with Oxford as a platform, in that it's a forum to generate deal flow for us. The platform or the relationship will last longer than any of the assets in it, typically. And we've had some stuff that we've sold, and we will buy more over time. Our private equity business, much like CPPIB, is based on a GP model with co-investment and direct investments, because that is the best way to access deal flow and the talent in that area. In infrastructure, we found that in order to get deal flow, we really needed to have an operating company on the ground. Otherwise, you're waiting for a very limited number of players in that space to invite you to the party. And we're large enough that we can be everywhere, but not big enough that we can drive deals. So we don't write. We can write big checks, but we can't write the check size consistently, say that CPPIB does. And so we don't necessarily get invited to the party. So in infrastructure, we have a platform that is 100% owned, that owns toll roads. We have one in managing airports. We have one in electric transmission. And so, the business evolved differently according to the needs of the primary drivers, which is how do we get expertise and how do we get deal flow?
Sophia?
For insurance company, it's a lot of challenge, but we are also quite lucky because I don't have to focus only on asset yield. If you compare with 10 years ago, my cost of liability for this insurance policy was as high as 5.4%. Today, my insurance cost is below 4%, and my break-even asset yield is a low 3%. So it's much better than 10 years ago. So I can try to balance if I train my agents well, and people are happy to take a little bit lower guarantee rate from Cathay because of my retail branding. And they will give me the time that eventually I can also manage some quality decision in asset allocation. To enhance asset yield, there were a couple of things we have done. One, every single asset classes, we have at least 1 to 3 teams, dedicated people. So just Cathay Life alone, we have more than 300 investment research talent. We also have the bank investment team, asset manager, and P&C insurance. And we are one of the largest institutional clients in Taiwan, so we can leverage sales side research. And at the meantime, I have an internal dedicated think tank, which I coach myself. There are 15 economists directly under me, and they hate me. You know how hard many economists understand financial market, but it works. For example, in 2014, when the world worried about China trust problem, banking problem, real estate problem, and through all the deep research, if you go through China's history, you can find it's the first time China cares so much about reform. And when Europe has PMI from 56 down to 50, and you have to think whether Euro recovery is delayed or disappear. If you put a lot of effort into global macro research, you can actually capture some of the alpha much earlier, so you got the time to prepare your portfolio adjustment. And we also appreciate the mandate managers, the fund house we use. We also put a lot of effort on hedging strategy. We are very lucky. We so far is, I would think, the best performer in terms of hedging. So you don't have to trust extra yield. If you save in hedging, it's actually the same as by taking more credit risk, for example. And for real estate, we have dedicated team. They've been actually longer experience than in financials. Actually, the whole group started with real estate back 6 decades ago. And we do own office building in London, for example. So it's a gradual expansion. And the beauty of the alternative investment is a lot of these PE fund, hedge funds, not just the asset yield enhancement, they also bring you a lot of industry insights. So we can also learn from those experts. And therefore, when we apply that to within the country, we are very supportive to government. The government want to do more infrastructure. You look at Taiwan concern on energy. So we are the biggest investor, one of the biggest one in solar installation, which is the loan by the bank, where for solar project, Cathay Life is also one of the major investors in the market. And for company, we try to partner with someone with very good operation experience, then we'll be happy to own 45%. So the yield is a lot better.
And maybe that's a good segue. I mean, if we can maybe move a little bit to the question around how we hold or steward these assets. What is interesting with all of the four organizations, I mean, you're very significant private markets. You still have also a lot of exposure to public markets. Now, governance and the stewarding of assets is very different. Ourselves as Partners Group, we have this somewhat unique situation that we are actually a listed company since 2006. We have a market cap of about $20 billion. And with that, we have, of course, a lot of exposure to public markets. And so when I was actually CEO for about 10 years, until about 2013, I had that annual tradition of meeting representatives of large asset management firms, pension funds, but then also, the BlackRocks of the world and so forth. And it was, for me, I must say, a little bit eye-opening. I mean, the kind of questions I would typically get from these type of, corporate action-focused people. I mean, there's no discussion about strategy. There's no discussion about, the market, the industry, competitive elements. Discussions were essentially around our compensation report and compliance. That's typically what people took up. Which is very eye-opening if your business is private market business, and that is, 70-80% of that business is not buying or selling a company, it's governing the business, right? Being on the board and running it and have your industry people getting in there. How do you work around this situation? I mean, if you own public assets, do you try, to use some of that approach from the private market side on the public side? You might be on the board sometimes, I guess, but I guess sometimes you will have small shares. You might not be on the board. I mean, it must be somewhat unsatisfactory, I assume. I mean, if you see what you can achieve actually with governance on a private market business, if you hold a public market portfolio. I mean, what's your perspective on that?
Oh, I can share my thoughts on
Please.
that first. I never think that, yes, private market, you have more direct contact with companies. And I believe people in communication. So it's regardless they are private or public, if you are an investor and your money is fine, but if you run public's money, half of the population in Taiwan are our customer. So we have been doing this responsible investment for 5 years already. And in the past 3 years, we're very active in climate action. So I'm a strong believer in ESG. And I'm now the chairperson for Asia Investment Group on climate change. We're very active on that. As long as you're an investor, you have the right to speak. And it's also obligation. And I always think your problem is my problem. If you don't care about ESG, that's my fault. So I spend a lot of time with either myself or other senior management. We go visit a company. We think they are a very good company. They just don't know how they should disclose, how they should care about different elements. But in Taiwan, we are very lucky because the government care about corporate governance. We also have stewardship code down in 2016
Sophia, do you get
already.
close enough? I mean, if you talk to the company, I could have told our representatives of large asset management firm any story. I mean, that they would have believed it if I told them what we do on carbon emission, what we would do in maybe certain more cultural areas. It's very hard, for a public shareholder, public company shareholder, to really understand what's going on in the firm, no?
Taiwan is such a small island with 23 million population.
Okay, that's for your domestic businesses.
Yes,
okay.
And internationally, if you buy the large names, actually they research themselves. They are under a lot of surveillance of global investors. If you invest in Apple, Google, Amazon, and the big names in the region, they research themselves. The thing is, can you see their future? How do this company think about their future strategy? Do they have proper committees within the company done? Are they accessible? If you want to talk to their top management, are they there?
Okay, so you said the proximity allows you, to be a bit like in a semi-private context. You can have a very direct discussion, you have visibility. Yeah. How different is that for the other three funds? How do you see public?
Yeah, I would say that any thought that we can engage as an individual investor in a company that we're holding in an index strategy is you're fooling yourself. You think you're going to have an impact. So there is potential impact from groups of institutions, as Sonia was describing, where you you band together, if you want. And what we believe is that companies that have an eye on their ESG practices tend to outperform over time. And so where we have engagement with them is, and all the industries know this, is on disclosure of their practices and transparency. And where the only time we actually engage outside of a group of institutions would be if we get contacted by a company asking, why did you vote against a certain proposal at the annual meeting, in which case we'll go through our logic with them. But the idea is to kind of raise all ships, if you want, through increasing and improving the ESG practices through the public markets. There's no question you can have a far greater impact on the privates.
I think it comes down to values, and whether you're buying a single share in a public company or whether you have a control position in private equity, you have to have some filters that just are important to you as an organization, important to you from a principle-based stylistic investment, and you just try to avoid those that are inconsistent with your values. So no question you've got little or no control when you're buying a common share. We are a direct investor. Our private equity business is a 100% control business. Our infrastructure business is lumpy decisions, so we have board seats. We can influence that every day, all day. But we do have a filter at our investment committee for ESG with a lens on diversity and inclusion, recognizing, as Neil said, that it's just a fact today that those who focus on those two things make better decisions. By the way, they're better aligned to our values. So it's really at the entry point where you can, if you use that filter properly, stay out of trouble. Is political correctness overplayed, particularly private markets today? Absolutely. But maybe it's underplayed sometimes in the entrepreneurial spirit and the lack of transparency in private equity. So you have to try to measure those two, and it all comes down to your values.
And what about in publics?
Publics, you have one choice to make, and that's early on. And maybe you can, band together, and we have at times in Canada, this table included, when somebody's misrepresenting something, as you suggested you might be quite good at.
I didn't, but I do believe that the understanding, so let me be more clear about that. The understanding of some of these representatives of asset management firms who inquire about, whether it's now ESG or compensation or anything of that nature, I think the inquiry is at a relatively limited level.
No, fair enough. It really is an entry point decision, and really having that sieve in the front end allows you to be aligned.
Mm-hmm. Yeah, and I agree with I think everything that's been said. It really depends on, frankly, through what strategic lens you're investing in public markets. If you take, we have a smaller part of our portfolio, which is the balancing portfolio, where we will take small stakes across indices and things like that, where I think those are real questions and you have to address them. But a lot of what we do in the public markets is actually active investing as well, where we take large positions in smaller companies, sit on boards where, frankly, you kind of manage those investments a little like a private investment. And so you have deep knowledge of everything that's going on. You take an active role in governance. So that would be a different thing. We have strategies that are, strangely to say for us, are more short-term driven in the public markets. They're around themes, deeply researched themes. Once these play out, you exit. So there's great knowledge of the business, but not so much an involvement in the governance of it. But that, again, is within a different time frame. And I would say there we are active in the way we manage our positions, and we'll have great knowledge of what's happening at the company level. As part of our active investment strategies, we actually don't do a whole lot of what you're describing, which is smaller stakes in large cap public listed assets, where it is, I agree with you, difficult to actually exercise any ESG or other governance related mandate. And we'll take the same approach as our peers from that standpoint. If something does come up, then you have to use different levers to be, but that's not really where we see the value add to our portfolio.
It's an interesting one. Let me quickly dive into that. I mean, many leading large investors, including the four of you, seem to have that perspective. You take a very large share of private market assets, whether that's now equity or infrastructure, real estate. You have maybe a tendency to focus also on smaller public companies where you have more influence. And then there is the I would say, the rest of the pension system, small pension funds, mutual funds, and so forth, that focus mostly on large cap equity. It seems like nearly a bifurcation between, I would say, maybe the more leading investors versus maybe a little bit the mass. Isn't this crazy? Is this sustainable? I mean, can we have essentially a setup where the investment universe is somewhat split between what is invested in by leading investors relative to what is invested by the typical pensioner?
It's not uncommon for us to find a great equity and take $1 billion position in a big cap company. So if we find conviction, take the Canadian banks, for example, where we know the management team, we know the dividend stream, we've had 50 years of earnings history, we understand their portfolio, we understand the risk and the proxy for what they believe in, we'll take a substantial position. So we are maybe different in that respect, and we actually like a size of that nature, and we would sooner have, it's like Warren Buffett, I'd sooner buy a great asset at a good price and be smart enough to get a good asset at a great price. We just try to get the greatest positions in some of those common equities, and we take a material chunk.
We actually do all, but I tend to think it's a bit risky. If I invest in a big chunk in a small company, I become a PE fund or hedge fund. So I can take the example, Taiwan Semiconductor, TSMC. They are more than 20% of the market cap of the market now. It's ETF buying and very strong advantage versus its peer. Foreign investor accounts for 80% of the stake. If you want to be part of the supply chain, you have to do a lot of social duty in terms of impact to environment, renewable energy, responsible labor environment, all those things. So I tend to think when after a company earn enough money, they want to be elegant. And I don't understand why people need to be monitored. If they are someone who need to invest, sit there, monitor every step they do, it's not a company I should invest. We will give the benefit of doubt, and you look at how they do their business, how they think. At the end of it, ESG is not about risk prevention. It's about the obligation to capture the opportunity. Do you enjoy the growth when you see? Do you prevent the risk you have? So it's come back to value, as you mentioned. It's how the company see their sense of value. That's very important.
It's very interesting you say this. I mean, I think one of the differences that I can see between private markets and public markets is that in private markets, ESG is usually part of the value creation. So for instance, our own ESG team, they sit in our value creation team. So these are the industrial people across the sectors. They essentially focus on how they can build a better procurement system or supply chain or grow revenues. And then you have people that literally are responsible to save energy and resources and change bulbs, whatever. But they are part of that team, actually, where in public markets, often the impression is, at least to me, that this is slightly more, I would say, communication-oriented, where people kind of collect the nice things and present this. I give you one interesting example where maybe sometimes, as a private market person, you get a little bit cynical about this. We had just last year, actually, an exit of an asset. It's a renewable asset in the US. It was a PV platform that we had built for about 2.5 years. Not a big asset, about 500 megawatt PV, which is roughly, let's say, 2 million megawatt is about $1 billion, maybe enterprise value asset. And it was in the middle of development, and someone came in and put up a bid for it at 1.8 multiple, which we felt we would achieve after maybe 5 years or so. And we couldn't believe it. And it was acquired by that company ultimately. So this was an oil company that bought that asset. Why did they buy it? I mean, that's at least, maybe that's an interpretation, but that's kind of how it came to us. It's because they have made that statement that they want to build up their renewable business, right? And I mean, if it's 200-300 million equity, that's for them 2 weeks free cash flow, so it's not a big deal for them, right? And then this is something that gets, of course, publicized in their annual report and so forth quite widely. Isn't there a risk that in public markets, I mean, and maybe if you're close in a local business, that can be a little bit different, but that public market companies start to take this, they play a very correct way?
It depends on the market. For example, in some Asian market, they are still in the early stage in developing corporate governance, not to mention about prosperity for all stakeholders. So it depends on every country where they are. You can see in Japan, they started corporate governance in 2013, and today they already just have TCFD consortium done, It's very fast accelerating, but we do have some investment in Southeast Asia countries, and not to name them, some of them do have even basic corporate governance issue. So I think it's all about relative. And then when you are investor, if you can talk to them, do so. If you can't, and you have some warning sign there, you have to think about maybe exit. At least I can exit.
Okay.
In private market, I can't.
Blake.
You know, we've got 500,000 people who are relying on their pensions to be paid, so we cannot, in and of itself, make a decision that we're going to invest because something falls into some politically correct term, ESG or otherwise. We invest in great companies. We invest in great individuals. We use that as a filter. We try to ensure that they are aligned with us in terms of values, but if someone wakes up because they have a business strategy around that, or diversity, inclusion, or anything else in and of itself, it's irresponsible for us to choose to do it just because. And so we are very careful to recognize the difference between a flash concept and a fundamentally well-based business that happens to believe in the same values we have.
Maybe we can open the round here for some questions. We have, I believe, 2 micros that we can pass around. If there's any questions from the audience, if you have to think first about questions, let me ask one other question in the meantime. So talk about long-term assets, the nature of it is illiquid. How do you see, current events, for instance, like at the moment in the Middle East, playing into questions around asset allocation, how much are geopolitical events, broadly speaking, but maybe also disruption? How much does this play into your thinking on long-term assets?
I'll take that. It's, our job is when we do...
And please raise your hands in the meantime. If you have any questions, we come around with a micro.
So we do global allocation of assets. It's a strategy. Diversification is the only free lunch. So we believe we need to be everywhere. And our challenge is when things are happening around the world to figure out, of course, we have a general hypothesis of growth and expectation of returns from different asset classes in different regions. And when things happen around the world, as there's always something happening around the world, we have to figure out, is it noise or is it a permanent change that would cause us to alter how we allocate for the long term? And if it's the latter, then we have to adjust. If it's the former, then it's an opportunity. And so the challenge, of course, is figuring out if it's noise or if it's opportunity or if it's long-term change. I was in Hong Kong 2 days ago. Of course, everyone's talking about the demonstrations. I spoke to my chairman last night, and he wanted to know about the potential of war in the Middle East with, drones attacking oil refineries. So, there's always something somewhere. And, does it represent a fundamental change or is it noise? One of the biggest challenges that we have as a global investor is trying to figure that out.
I would agree with that. We think diversification across asset classes and across geographies is one of the best ways to add value per given unit of risk. So I think we're committed to it. If you look around the world, there is uncertainty just about everywhere. It wasn't so long ago when I went to our board of directors, people were really worried about deploying capital in Europe. So I think if you look beyond the headlines, and I agree, having boots on the ground, having people in the markets close to our partners, close to our assets, is the best way to actually see through the main headlines and think about long-term value creation and where you think that value is going to come from. I actually think that if you're an active investor and you're deeply deployed in these markets, that can become an advantage. Because you can actually take a long-term perspective, find great opportunities in times of dislocation. Actually, and on a relative basis, what's happening around the world today, you could argue there will be dislocation at one point or another in every region where you invest. And so we choose to look at this as a potential angle for long-term value creation.
I'll probably agree with that approach. In our own practice, we usually ask ourselves the question for any asset around different disruption risks. Is it an asset we have to avoid, or is it an asset that will actually benefit from it, right? If you grow this, develop it the right way. So I probably agree with that. I do believe we have a few questions out of the audience.
Hi, Patrick Durkin, Atlas Merchant Capital. Given the data that you showed, and it seems a common belief that you're going to be able over the long term to produce greater returns in private markets versus public. Do you see an accelerating shift where that will become more competitive, more significant institutional capital goes in that direction, and the public markets shrink?
Maybe I can start from my perspective, but I'm certainly happy to make the round here. I think there's a couple of things happening. First of all, our world has become super competitive. There's no doubt about it. I can tell you that the business we run today, I would say 15 years ago, you would have done with maybe 300 people. And today we have 1,500 people for that business. And we are more like in the middle market. It's coming with a very, very significant effort. I do believe, though, there are factors that help us, as supportive. I mean, if you look at the number of public businesses over the last 15, 20 years, that number has halved roughly. We had mid-90s, we had about 8,000 public firms in the US, for instance. We have today about 4,000 or so. There is clearly a shift, and we see that shift, by the way, if we develop businesses, if we hire talent. I mean, we see clearly there's a lot of talent that has a preference for private market for all different reasons. One of it has a little bit to do with this governance, focus, correctness, and things like that. How much of that shift between public market to private markets, and that has been about 1 to 5 trillion in the last 10, 15 years, how much of that do we need to see that we can absorb all that demand that we see by very large institutions, but also a lot of small institutions that all go indirectly through funds? It's a little bit hard to predict. If anything, I would probably say this outperformance element, I think that is to stay. Whether we see that in the same magnitude as in the past, I probably personally doubt it somewhat.
I would just add, it's a relative term shrinking, and I think you will see massive growth because it's a winner-take-all world. It's incredibly competitive for great equities, and I think, but on a relative basis, you'll see more money flow to privates, and just because of the wall of capital that's out there focused on great private businesses. So whether that's infrastructure, real estate, and the like. So, but they're all growing because nobody is all that enamored with fixed instruments today, and that is the $64,000 question: is what do you do with that component of your book that today is in many countries delivering negative returns?
If I look at the total assets in terms of dollar, not the number of companies, I do think the private market will grow, but the public market will. You look at how fast global households are accumulating their wealth. The larger companies are growing their cash balance. So I worry more about some trends. One, more retail happy to give their money to asset owners and asset managers, and therefore those are the investors into private market. But when we are managing much bigger assets than before, are we taking the responsibility on risk pricing discipline? And these are retail's money, and by spoiling large corporate lower rate, and therefore once your spread gets narrow, the banks will be shifting to more safer spectrum of their credit risk preference. And that's why a lot of companies eventually go to PE fund, for example. So, and once the cycle goes, eventually you lower deposit rate, and later you affect consumption. And once weaker retail demand, it becomes weaker capex for corporate. So how this asset manager, asset owner have a proper risk pricing discipline, including central bank's discipline, that does concern me. And once you got more complaint from general public, it becomes social instability, country among country, this fight, it's just become quite worrisome. So I do think with the yields on the asset every year, you do have very strong support to both public and private. But I do think whoever manager in public-private should take the responsibility on better risk pricing discipline.
Do we have more questions from the audience? There's one question over there.
Hi. I had a question for the panel. In terms of your journey towards stewarding long-term assets, how important is sourcing talent in terms of stewarding those long-term assets? Because I understand from the panel, you all, take an active management approach in investing and managing your assets. So I suppose you would have to, source in-house talent. So how important is sourcing talent? Are you facing any challenges? Is it one of your primary concerns moving forward? Because there must be a cost as well in terms of building an in-house in-house talent team?
Is the question social talent?
No, sourcing talent.
Sourcing.
So the competition for talent.
I'm happy to. I mean, it is something that we think about every day, and I think it goes to your governance. And I think one of my colleagues mentioned early on is the model of the Canadian pension system is to be competitive with the market in terms of compensation. I think we offer a great career trajectory, long-term certainty of assets. I think there are a number of things that we think make us attractive as employers of talent. But we have a number of different strategies, and for each strategy, our level of competitiveness with the market is different. And there's some of our strategies where that is more complicated. Private equity is a great example. It is an industry in direct private equity investments where the spoils are great to those who are successful, and to be able to attract and maintain talent as we grow that platform, which is a key source of value creation for CPPIB, is probably one of the biggest challenges we have today, is to hold on to that talent and to be able to keep attracting.
That's probably a bit of winner takes it all effect here.
So, quick anecdote on that. I think we're out of time, but when you think about presentations, and it's almost like my head of HR is in the room and planted the question, because when you think of all the presentations you see on what's going to be key to the organization going forward, every time you're looking at the PowerPoint, you always talk about this skill and that skill and being local. And then way over on the right-hand side, there's something called talent. Okay? And we've made a conscious decision to always put talent on the left-hand side going forward. And this can be the first thing we talk about, because it is the most important thing that's going to drive us going forward.
The only thing better than our assets are our people. And without the people, you're never going to get the great assets. And without you're scaling a business, great people attract great people. So totally valid question, and that is the rarest commodity. We had a PhD in the other day, by the way, and I thought you said social talent, who teaches at Stanford. He spent 10 years studying it. He said, what's the most compelling, most important thing in the future in terms of skills for this generation? And he said, everybody has one of these computers. Everybody can get to the same answer. Back to social skills and back to network. And if there's anything more important than that, nobody knows what it might be today. It shouldn't take a PhD at Stanford to tell us that, but that's important to all of us, and people are everything. So
I think we are unfortunately reminded to wrap up here for about 3 minutes, so everybody gets a little bit nervous, I think. I think this was a great last question, actually, because ultimately this question goes to many, many of the questions asked before. Our industry is a lot about talent, having the right people, and I think that makes ultimately a difference for all of us. Thanks a lot for all the wisdom, the insights, and for your patience. Thank you.